There's starting to be more evidence of a slowing economy as consumer spending has started to decline, and consumer spending makes up about 66% of the economy. As a result, there's starting to be fears of a decline in growth. And yesterday's ISM manufacturing numbers were weaker than expected, indicating lower growth. And then today we had lower than expected JOLTs job opening numbers coming in at 8.06 million, lower than the 8.4 million from the month before, and lower than consensus forecast. These are the lowest numbers for job openings, hiring and quits since basically 2021, 3 years ago, and pretty much lower than right before the pandemic hit. So the labor market is starting to cool, and the economy is starting to weaken slightly. As a result, the Federal Reserve's GDP now forecast from the Atlanta Fed indicates a decline in projected second quarter GDP growth to be 1.8%. It was originally 2.7% a little over a week ago, but with these latest weaker than expected numbers and a decline in consumer spending and lower than expected job openings, the Atlanta Fed GDP now shows that their estimate of being 1.8% GDP growth for Q2. So that's something we have to keep in mind. This increases the probability that a Federal Reserve rate cut could come in September rather than December. And there's even some chance of it even being in July. Economist Mohamed Al-Arian thinks July could be a possibility. So this is something we have to watch as the economic data comes in. We also had E-Trade make an announcement yesterday that they're thinking about banning Roaring Kitty, his real name's Keith Gill, from the account due to the volatility of GameStop. I'm not really sure if that's necessarily the right move to make. He just posted that he owned those positions. It doesn't seem like he has any inside knowledge. And look, Congress trades a lot on stocks and profits, very likely with information before they propose bills and legislation. So if they can do that, then I don't see why Keith Gill couldn't do what he did with his Reddit post and disclosing his positions the other day. So that's something that we have to keep in mind. But right now, the markets, tech is doing pretty well in small cap stocks, with the odds that we might have a rate cut in either September or July due to this weaker than expected data. Obviously, we have to see how this plays out, but unfortunately, this weaker than expected data increases the odds of an earlier Federal Reserve rate cut, which is good for markets. And unfortunately, the stock market isn't the economy. And right now, NVIDIA and the AI stocks are really holding up this market right now. There's a dichotomy between the Magnificent Seven and AI stocks and the rest of the market. So hopefully those kinds of stocks continue to do well. They're holding up this market, but they're really enhancing the performance of this market and holding it up, in my opinion, right now. One more point I'd like to make is that Fundstrat's Tom Lee went on CNBC this morning saying he thinks that the S&P 500 could hit a level of 5,500 by the end of June, which is 4% upside from here. He thinks this because he thinks inflation's going to fall more. We'll have an increased amount of disinflation. He thinks that there's $6 trillion in cash on the sidelines and money market funds that will likely chase this market rally. And there's lower levels of margin debt right now, so that means that there's less irrational exuberance or less, leverage and greed going into the markets. So he thinks that we could hit that price level of 5,500 by the end of June, and I honestly kind of agree with him. That doesn't mean we can't have a pullback in July or August, but there's a lot of, especially with this weaker data, the Federal Reserve has to cut rates earlier than expected. That'll likely help the markets, in my opinion. I know this video is starting to get long now, but I wanted to lastly touch on oil. Oil fell 10% in 5 days, despite OPEC extending their production cuts through the end of next year. Normally, that decrease of supply should place oil prices up, and normally oil would go higher. However, oil's now down 10% over the last 5 days. Why is that? Well, there's starting to be fears of weakening demand and a slowdown in the economy, and that's outweighing OPEC extending their production cuts. Yes, you could also counteract some of that because they're allowing some barrels of oil to come back into the market in October, but they're still extending the majority of production cuts into the end of the next year. So yeah, that's why oil's down right now, is because there's fears of weakening demand due to a slowing economy. So we'll likely see oil and gas prices decline in the weeks and months to come if demand continues to slow. Obviously, we have to see. Bond yields also hit 4.36% for the 10-year, which is getting close to its 200-day moving average. So that if it hits that, that's kind of a sign of inflation expectations. And the lower bond yields go, that means bond prices will go higher, which is normally good for stocks.